Okay, well, let's make a start. Welcome, everybody, to the Fortlake Fireside Chat. My name's John Baird, and I'll be your host for the presentation today. Presenting, we have Dr Christian Baylis, who's the founder and CIO of Fortlake Asset Management. Welcome, Christian.
Thanks, JB. Thanks for having me.
Not a problem. A couple of quick housekeeping items before we get started. This is intended to be an interactive session, so we'd appreciate your questions. Please use the Q&A bar down the bottom of your tab within the Zoom chat, and post those questions throughout the session, and we'll seek to get to as many of those questions as we can throughout the 30 minutes allotted. I think it would be worthwhile to start by providing a bit of an overview of the events and drivers that have impacted markets over the past quarter. Would you mind sharing your thoughts on that?
Yeah, so I think it's probably worth just setting the scene. I think it probably goes without saying that we've had, a historical episode, but with that, there's not many historical precedents, which allows us to make any sort of proper assessment of the correct policy path going forward, or indeed how to interpret a lot of the data and the things that have come to light as a result of the pandemic. So I think, something that we've obviously been focusing on a lot is this two-sided uncertainty that's out there in the market at the moment. And I think the troubling thing there is that as we go through the modelling process with most of the macro variables, what we're finding is that troubling trends and consistent errors always tilting to one direction of the central estimate, so always going higher. And that really is something that's been a feature for about 18 months. And in that environment, it's been surprising somewhat until probably recently that the central banking community really hasn't moderated its guidance. If anything, it's been a bit more certain about the way it's forecasting outcomes in terms of its communication. And we think that probably now, just over the last few weeks, actually, that finally central banks have really started to up the ante in terms of letting people know that this is really a different environment. So I think something that we've been focusing on is managing policy for tail outcomes. And this is something that we wrote a paper on about 12 months ago. And what I mean by that is we've seen a lot of policy implementation on the downside, managing for tail outcomes, i.e. we've seen 100 basis point cuts. We've seen emergency responses to the downside. But to the upside, we haven't really seen the central banks accept that this is a 3 to 4 standard deviation event, which typically is a tail outcome, and therefore a tail risk, which is actually starting to eventuate, or is actually, we are living that experience now as we speak. So obviously you've got the Federal Reserve, I think is the one outlier there. They have moved to that type of policy setting. It's by no accident that they're talking about increasing by 50 basis points in May and June, and that's pretty much 100% price now. But saying that, I fear the central banking community has and still is looking at the world somewhat stochastically. And by that, I mean using historical episodes to adjudicate on the required action for the current episode. And I think what you've got to be careful there is that when you're dealing with these tail type of outcomes, anything goes, and you need to be very open-minded to the way that you're viewing the world. And I think, the reason it's important to assess this situation separately and independently is that we've never seen a crisis with no psychological scarring. This was the quickest fall in GDP and the quickest recovery, all within the space of a few months. And that's not something that we've ever seen before. And when you don't have a protracted, deep recession with lots of psychological scarring, typically that means the behavioural characteristics that come out of those types of crisis episodes are very different. And that's certainly what we've seen. And that's why, I guess, the Phillips curve and some of these elasticity type of models are really showing, very supercharged responses to policy and stimulus because of that lack of psychological scarring. That wasn't the experience that we had coming out the back of the GFC. It wasn't the experience that we had coming out the back of the 1946-48 World War. In most of those crises, we saw very long, protracted periods of recessions and ebbing and flowing back to a more normalised world. So I guess the next point is, how do we actually ascertain that we're actually living through a tail outcome? Well, I think there's enough data out there that we can safely say that this is happening. we've got wages in the market clearing economies, which I tend to characterise as the UK and the US. And what I mean by that, these tend to be much more free market type economies, particularly at the labour level. As an example, in the US, the minimum wage there is $7.25. In the UK, it's £9.50 pounds. Here in Australia, we're at $20.33 per hour. So what I mean by that is you've heard the RBA talking a lot about using wages as a harbinger for a policy response. Now, the problem with that is that we are not a market clearing economy when it comes to labour rates. The US and UK rates, as you've just heard, those rates are so low that they are effective market clearing rates. And the reason we should look to those economies as a harbinger for what's actually going on in the G7 economies is, number one, they make up a good portion of the G7 economies. Number two, it tells us what's actually happening in those market clearing economies. And it should provide us with a pretty good proxy for what's going on here in the absence of frictional or enterprise style contracts and enterprise agreements that we have here in Australia. We are a contracted labour market, and that's a very different thing. So I dare say that looking to the wage levels here isn't really going to give you a good anticipation of what's actually happening at the CPI level. And keep in mind that 80% of the CPI is directly and indirectly tied to labour rates. So this should be a forewarning. Looking to these economies, as I said, 3 to 4 standard deviation moves from the 10-year average. That's how far and how extreme some of those labour rates have moved in recent times. And what we really need to see is start to see wages start to keep up with inflation. That gap between inflation and wages has been increasing. This also means the prospect of high inflation and low growth is a possibility, because when you've got that gap between wages and CPI, it means the impact on people's living standards is greater. And then I guess, just going back to some of these other points, we've got the CPI also at 3 to 4 standard deviations away from the 2020 forecast. We've got GDP at 3 to 4 standard deviations away from the 2020 forecast. And we have an ever growing number of items in the CPI basket diffusing higher to be well above prior periods, and diffusion indexes, which we tend to look at a lot, are very good turning points, are very good indications of turning points in the markets. And they've been flashing red for some time. So despite all of this, to make matters somewhat worse, we haven't been able to wean ourselves off structural and cyclical deficits. So whilst we've got inflation and some of the macro indicators pointing to a pretty strong and robust recovery, we don't have the fiscal side contracting at all, and we don't have any fiscal response, at least trying to slow things down. And so, that is of somewhat of a concern as well. So you've potentially got a situation where the central banks are tapping the brakes, and then you've actually got the fiscal authorities, tapping the accelerator, and that doesn't seem to be changing anytime soon. So I guess what it comes back to here is that we're experiencing probably a pretty bad inflation cocktail, really. You've got demand pull and you've got cost push. And for anyone on the call that hasn't heard those phrases before, typically you never see those two mentioned in the same sentence when talking about CPI. It's usually one or the other. In pretty much every other episode, it's usually come from one side or the other. But in this episode, we're actually seeing both sides pulling there. So demand is robust. Demand is stronger than expected. It was originally a supply side issue, which is the cost push side. That is also going at the same time, and so you've got effectively a CPI pincer where both sides of the ledger are working against, I guess, a normalised environment. So I guess what we have to consider here is also the geopolitical environment. All of the things that I've been talking about were pre-Russia-Ukraine. And therefore, some of those tail risks probably have only grown over the recent past. And I guess just pointing to some things that are of particular interest here. In our recent commentary, we talked about effectively this inflation tax that's now upon us. That's certainly the case in the US. It will certainly be the case here in Australia. And again, as I said before, these trends in the areas that I was previously talking about, these have been with us now for 18 months. And there's a price to pay by moving away from forecast dependency and moving to data dependency. And if you want more assured outcomes in the world, you have to pay a price. And that's what central banks made that trade-off. They said, we want to see data. We're not going to move in advance. We're not going to make assessments of the future in an uncertain environment. But what comes with that is a price. And that's certainly what we're seeing through this quasi-inflation tax that's starting to come through the economy. And this can be...
It's a really interesting one, Shun. I mean, you mentioned the Phillips curve earlier. This is something that the policymakers aren't really talking about, Nauru, and even the neutral rate. Do you have any views around where the neutral rate is? We've got a couple of questions coming through on that, the forecastability of the neutral rate. Do you have any views there?
Yeah, so I think going back, to 2007 and beyond, the neutral rate started to taper down. So you had the neutral rate, which was at about 3.5% from 2000 to 2007, and certainly through the 90s. And then as the economic environment started to change, we obviously had the financial crisis. We sort of based out at around 75 basis points of the neutral rate. And for anyone that's on the call, the neutral rate is a real rate, and it's a real rate which is meant to be an equilibrium rate, which basically is where we have a stable inflationary environment. Now, recent estimates have been sort of, as I said, around that 75 to 1%, but given the data and the things that are coming through now, we would estimate that neutral rate is at about 2.5%. And the really interesting thing there is that we've got real rates in Australia at negative 3.5% at the moment, and we've got a neutral rate at 2.5%. So we've got a 6% gap between the estimated neutral rate and where the real cash rate is at the moment. That's a really, really large gap. So what that's basically saying is we've got 6% of territory to cover until we only start to neutralise inflation. And you think about the US, they're in a far worse situation. They're at 7.9% inflation. They've obviously had one hike. And their neutral rate is around 2.5% as well, or estimates are around 2.25 to 2.5. So they're a long way behind. But I guess the worst thing with all of this is that we're talking about a neutral rate moving up from 1 to 2.5%, which is fair given what's happening in the macro data. But the critical point there is that the two-sided uncertainty on that neutral rate, it's a theoretical number, is also double what it used to be. So going into the crisis, the degrees or the distribution of possible outcomes on CPI, on neutral rates, is double what it used to be. So we used to have 500 to 600 possible outcomes in CPI and neutral rates. Now we've got around 1,200 to 1,300. And as I said, the troubling thing there is all of these distributions of outcomes seem to be trending to the high side of the central estimate. Now, if we actually, so what that means is that if we've got a 2.5% neutral rate and the two-sided error was typically 100 basis points either side, going into this, it's now 200 basis points either side. So we could conceivably have a neutral rate in Australia of 4.5%, and that would still be very normal in terms of a model outcome. Now, if you think of that we're at negative 3.5% in the real cash rate, and that we could actually potentially have to go to 4.5% in the real rate, I mean, you're talking considerable movements on the cash rate here. And I think this is the thing that I just haven't heard many economists talking about. It's something that I think needs to be talked about a lot more. But the concerning thing is just the level of volatility and the proxies for volatility in the economy. I mean, interest rate volatility is at all-time highs in parts of the curve at the moment. And that also tells you that neutral rate volatility has a similar type of volatility as well. Now, typically what brings that neutral rate higher, what are the big drivers? It's typically savings and investment. We know savings are going to go a lot lower. In fact, in Australia, the savings rates dropped from high 19s to low 13s now. The US, all savings rates in G7 economies are pretty much dropping at a rapid rate. And investment is another thing that drives that neutral rate higher. We know people are going to be looking to invest to cover the cost of inflation. All of these things, I guess, are foreboding of a higher neutral rate, but potentially with upside risks to it, not downside risks. And I think that's the thing that we need to start focusing on a bit more, that this could be a much more rapid type of outcome than what we're expecting. And certainly the early evidence is pointing to that we could be living through a tail outcome. And it's something that I think central bankers need to think a bit more actively about.
Definitely a concerning thought if we look to the extreme tales of that situation. You mentioned earlier the Russia-Ukraine conflict. We've had another question come through just asking for you to expand on that. Obviously, there's been a lot documented in mainstream media on the topic. Without wanting to recover any of that, do you have any, I guess, unique perspectives on the conflicts and especially the implications for markets?
Yeah, it's an interesting one. I think, look, I don't want to sort of go over sort of mainstream news. So I'll certainly try to address that one through the bond market. I think is probably the best way to do it. Stick with what you know. So I think there, it probably requires a little bit of historical context on the Russian debt situation. They've got around about $150 billion out there in foreign currency debt, a mixture of government and SOE debt. And I think, you probably need, with that historical context, there has been, Russia does seem to burst to prominence every now and again. I think, back in 1918, they defaulted. 1988, they came really close to defaulting on the Brady bonds. But believe it or not, there's people still out there trying to get redemption on some of those 1918 bonds as well. So that's how long the Russians can really hold out on coming good, on paying their debts. And creditors are not going to be able to find, enforce, seize and get full repayment in full on a lot of this debt. The standard gamble for creditors with sovereign defaults is to be persistent and be so painful that ultimately the sovereign gives up and just pays you. That's certainly what you saw with Argentina. That's certainly what you saw with Peru. It's certainly what you've seen with other defaults, the Mexican debt crisis. But I think recent historical examples illustrate that Russia is plenty capable of outlasting the most persistent of creditors. So this will be a true battle. But I think what's really interesting is, we did a bit of work going through Russian docs, going into, I guess, the generic bond docs that you see. And this is probably the most fascinating thing I find about the war over there, is that if you actually read the generic bond documents of the Russian sovereign, you would get a very good indication that their intention was always to go to war. Bonds going back over 100, 200 years have always been issued, typically for wars going back 100, 200 years ago. Not so much in the modern era, obviously, but typically going back into the 1918 era and stuff like that, when you had the Tsarist imperial bonds. They were issuing bonds and war bonds and peace bonds and things like that. So it's a really interesting thing. But what you saw in these pretty bland, dull contract docs was that the Russians actually made some very sneaky changes post 2014, just after they invaded Crimea. And these generic Euro docs really slipped in some things that were against or not typical of the boilerplate that you see with sovereign docs. One of the key things that you saw there was this alternative currency payment clause. And I think everyone has probably heard that on the 16th of March, the Russians had 117 million of interest due on 2 tranches of dollar bonds, and they paid that in rubles. Now, people weren't clear on whether or not they could do that, but they certainly have put that into their docs. Now, as I said, this was snuck into the contracts post the Crimean invasion. And really what they've done there is these docs have effectively given Putin a leave pass for misbehaving and allowing Russia to use alternative payment methods in order to circumnavigate the harshest effects of future sanctions. This is akin to providing Russia with insurance for bad behaviour. So the other clauses of significance that also come up is they've got this clause in there that says reasons beyond its control. So they can pay in rubles if there's reasons beyond its control, which is a remarkable thing to have in your docs. No one else has that. No other sovereign has that. So they can choose whatever denomination, rubles or otherwise, to make a payment if it's beyond their control. The funny thing about that is, who's the dictator of that control? Is it Putin himself? The docs are totally silent on who actually determines if it is beyond its control. So the major question there is, what are the circumstances which constitute a situation which is out of Russia's control, i.e. is its inability to access foreign currency reserves, The problem here is the contracts are silent, and it's a really fascinating case study because we really haven't seen this before. But the only reason I'm mentioning this is because it really will set up the way that sovereign bonds are issued going forward. And it
is
really
quite
will.
incredible, given they are 6% the emerging market debt index. So this is not a small issuer of bonds out in the market, not a periphery frontier type market by any stretch. So it's a very interesting observation, one which the market hasn't really picked up on.
It's a fascinating thing, and I dare say the investors that hold Russian debt at the moment wouldn't have picked up on it, which is and again, like you say, they're not a bit player in the economy. I mean, they're 3.1% of global GDP. That's bigger than probably what people realise. So it's a really fascinating thing. And the other sneaky trick that they've put in there is that they don't outline what jurisdiction for determination in any type of legal issue around default. So they clearly say they do not submit to any foreign jurisdiction. But is that legible? Can they actually do that? No other bond doc does that. Typically, bond docs will be issued in British law, under British law, or have a jurisdiction for which disagreements are run through the courts. So that's a fascinating thing. They're the only fly in the ointment there, I'd say, is that what you have found in prior defaults is that if you issue into a country, basically what a court will say. So if you've issued in the London market or under UK law, they will typically say, you've come over here, you've engaged in commercial activity, therefore you're bound by our law. And there are some precedential laws in relation to that. But the interesting thing there is we actually do have some prior examples of, I guess, state-owned enterprise defaults in Russia. You've got the UCOS case, which is an interesting one. And again, investors just haven't paid attention to that. What the Russians did in that case, they misappropriated all of the funds. So they basically went out, raised bonds. The Russian government took all the money from the corporate and basically put it into a default situation. The market really hasn't penalised Russia for that. And they basically haven't put a risk premium into the sovereign bonds. So despite all of these things, the market really hasn't been paying attention to how devious some of these contract changes were. It's a very murky area, but again, it provides really interesting opportunities for other defaulting or restructurings in the sovereign space. The interesting thing here about oligarch assets and those sorts of things, again,
looks like
which is very unique.
Sorry, Christian, you just froze there for a second.
Sorry, I was just talking about the expropriation of oligarch assets, and really what you have at the moment is you've got this political movement to expropriate oligarch assets. It's not being done by the courts, and that's really unique as well. And we'll sort of go into this a little bit further, but at the moment, sovereigns have just walked in and grabbed Russian assets off people who they believe to be connected to the state. And this is, and in the event of a Russian default, does this mean those assets will be liquidated and paid out to Russian creditors of the state? All these things are really unclear, and it sets up a precedent for future sovereign defaults. Equally, you've also seen the confiscation of reserves as well. So Russia's foreign currency reserves have been expropriated by the US and by other countries. If there's a Russian default, can the US grab those reserves and effectively use them to pay out creditors? All of these things will really have quite dramatic changes on the bond market, actually. That wasn't the original intention, I don't think, to confiscate reserve assets and use them for creditor compensation. But I think that's really interesting. And probably the most important thing here is just the pari passu clause that sits in there. And this is a pretty bland clause that sits in most bond documents. But really, what's happened here is, Paul Singer, or from Elliott Asset Management, was the first to sort of bring this up in the Peru situation. And for anyone on the call wondering what pari passu means, it means in equal step. And Singer basically took Peru to court and won on this pari passu clause. And what happened there was they bought the non-restructured bonds in Peru, and Peru tried to give them the restructured rate of 20%, and they said, no, on a pari passu basis, you've paid everyone else 100% of the 20%. We bought the non-restructured bonds, you should be paying us 100%. And they actually won that court case in Brussels, in a Brussels court, and that really set up Elliott Asset Management to win again in the Argentine case, where they actually bought Argentinian bonds. They went and sued Argentina and made $2 billion odd on Argentinian debt on the back of that same case. Everyone said that pari passu clause wouldn't go further than the Brussels court system. It's now sort of gone into British and American law, and so these sorts of things are really, really interesting. And the last final point I'll just make on Russia is it says that the bonds they've snuck in this. They've deleted something in the clause that says the bonds rank. So, typical clause in bond documents, it says the bonds rank and will rank, and whereas Russia's deleted will rank out of their bond docs. So all it says in the Russian docs for sovereign investors is that the bonds rank. So they've basically said there's no future ranking clause which allows Russia to sequester its outstanding bonds and issue more senior debt above all of those bondholders at the moment. So they can basically destroy any one of these bondholders. And I think that's why you're seeing Russian debt trade in the market now at around 4 to 5 cents in the dollar, because they can basically just be restructured out. So some of these lapses, I guess, in market concentration on bond docs can be really detrimental. And you wouldn't think that it's happening at the sovereign level, but it just shows you what it is. And I think the interesting thing about the oligarch assets, this is what they call veil piercing. And again, Elliott was another interesting case here, where they were able to seize boats of people in the Argentinian case and actually use that as redemption as a creditor. So this veil piercing scenario, which they call it in the courts, is basically a witch hunt for alter egos of the Russian state, and looking for oligarchs who ultimately hold assets which could in fact actually be connected to a Russian default. In some cases, creditors have struck out on that; they haven't done well. But in the case of Argentina with Elliott, they were able to seize boats of people and things like that. So there's a pretty different way of looking at the Russian debt crisis.
Very, very different way, and obviously a lot to play out, especially as it pertains to the bond market. Look, just mindful of the time, maybe just quickly turning towards markets. We spoke a lot about the macro drivers looking at inflation. We've got about 6 rate hikes in the US priced in, 5 here in Australia. And we've got very flat to inverted yield curves across the developed world. Is this a sign that the market is pricing in too aggressive behaviour from the policymakers, or what's your view on that?
No, I don't think it is too aggressive, because again, I think it goes to this point of if we accept that the neutral rates have moved higher and back to those more normalised levels of the early 2000s and the 90s, there's a long way to go to get ourselves back there. I think what we're ultimately seeing is I think the reason why it's been hard to accept these movements in the rates market and why people have doubted them is because our immediate past experience has been off such a low base level, and it just takes a long time to adjust to that. But even when you still look at it today, we've still got a long way to go just to get back to neutral. And even when you get back to neutral, that's only neutral. We haven't even talked about tightening past neutral in the case that we actually need to jam on the brakes. So this is the world I think we're in. It's going to be around for a long time. And again, I think, for rates, the surprises are definitely to the upside, not to the downside. There's nothing that's pointing to a moderating environment. If anything, the surprises keep festering away. And I think, I think it's going to be with us. And I think, I think the US says it all: 50 hikes in May and June. That's crisis type hikes. I mean, that's crisis hikes on the upside. I mean, that's really significant compared to any historical precedent that we've seen before. As I said, we've seen it on the downside. We haven't seen it much on the upside with inflation. So that shows you what one of the largest economies in the world is facing in terms of where it's going and what it's doing. And yeah, it will be certainly interesting to see where we are in 12 months' time. But certainly, I think the disconnect is definitely in Australia still. The US is trading above the Australian rate market in the front end of the curve, but below it in around the 3-year part of the curve. And I think what that's telling us is that the more delayed you are as a central bank, the more aggressive you're going to have to be a bit later. And the analogy I typically give is if you're jumping out of a plane with a parachute, the longer you wait to pull the ripcord, the heavier the fall is going to be. And I think the difference between Australia and the US is the US is pulling the ripcord a lot earlier and really trying to stamp on inflation and send a signal to the market that it's here to fight inflation, it's here to protect price stability. But in Australia's case, clearly there's a big credibility gap between what the market is pricing and what the RBA is saying. And I think when you look at the RBA, you look at it and you go, if we use the gap between communication and market pricing as a barometer of inflation fighting bona fides, the RBA is coming last out of the developed economies by a long stretch. It's pretty much the only economy that has market pricing well advanced of its communication. And, this could sort of hark back to some of the issues around the targets on the 3-year being broken on that. Some of the communication stumbles that it had around saying that rates wouldn't be lifted till 2024. It has a long way to go and a lot to do in terms of, I think, getting the market belief back in its bona fides.
So I guess flipping to the other side of the fixed income market, thinking about credits, we've got a question here regarding credit spreads. We've seen them widen pretty consistently since, so it's really since September that marched wider, especially here in Australia. Is this a buying opportunity, or do you think this is a broader, sign that we're in the late stages of the credit cycle?
Yeah, I think, look, we've got to be in the late stages of the credit cycle just by simple math. I mean, we haven't had a high yield default in the CDX high yield market. We haven't had a high yield default in Europe either. And the reason we haven't had defaults is because we've been living through a world of financial repression. When you've got negative real rates as a high yield issuer, it requires a fair bit of talent to actually default. The same has been applicable to households and the like. Is we've basically been living in a free real funding environment. You don't need to be very creditworthy to survive that. And what we should start to see is that after 2 years of no defaults, we should start to see that happening in the high yield market. You would think within about I would say a 6 to 12 month period once interest rates go up. And the reason that you're going to start to see defaults come back is because the cost of capital is going to be higher. The cost of capital is going to be higher because spreads are wider. The cost of capital is going to be higher because interest rates are higher. Spreads are widening on the back of interest rates going higher. But equally, the cost of capital at the equity level is going to be more expensive. The reason equity capital is becoming more expensive is because inflation is running at 7.9% in the US. People often ask me, rightly or wrongly, what are your views on the equity market? And I say, well, you've got a 7.9% handicap to get going on the equity market. So just because equity markets aren't falling doesn't mean you're not losing money. It's the same with cash. Is we have to start looking at every asset class now in real terms, because inflation is 3 to 4 standard deviations away from where we're expecting. And inflation is really the single biggest detractor of real returns at the moment. And so you've got to think about that from a corporate perspective. It means corporate's going to have to be much more prudent about dividend and distribution policies and the like. But really what we're starting to see is really good opportunities to set yourself up to benefit from some of those defaults in the more toxic parts of the market. And that's certainly the way we're starting to position ourselves.
Yep. Pretty interesting outlook there for the credit cycle, and one that's really interesting. No defaults in high yield for 2 years is quite extraordinary, considering it normally runs at circa 4 to 5% in a typical year. We've got a question here. I'll edit it a little bit because I won't have the competitor they've raised, but effectively saying that they've got another credit-based investment manager in conjunction with Fortlake, and just curious to how the portfolios generated a positive return during March, despite the competitors and the credit market being underwater in such a dramatic manner?
Yeah, no, thanks for the question. So look, I mean, it's we do run a pretty active hedging book. You know, we tend to pepper the portfolios with what we call exponential hedges. Volatility, you know, went to pandemic type highs in many cases across many different markets over the earlier parts of March. That provided very good opportunities to take hedges off, crystallize hedges. There was a lot of basis in the earlier part of the month. You know, once the basis settled down and once volatility started to surface, it really allowed portfolio managers that are pretty active in those non-linear products to effectively take off hedges and I guess bring portfolios back to an even keel. So that's certainly what we saw. As I said, high yield was on the move. It has been on the move. Crossover in Europe was out 100 basis points in the space of 5 days. I mean, that's just a remarkable move. In the US, you're out sort of 60, 70 odd basis points in pretty quick succession as well. You know, all of those things provide opportunities when you're tackling both sides of the market. The one thing we always say to people is, when you're a plain vanilla cash bond manager, you've got one degree of freedom to generate returns from. When you have numerous silos and numerous directional opportunities across those silos, the arithmetic really is quite simple. It allows you to diversify. It allows you to take advantage of different parts of the market. And certainly, I think this is one of those markets where things are starting to pop up in different areas, and having those degrees of freedom really helps.
Yeah, thanks for that, Christian. We do have quite a few questions that we haven't got to yet, but I'm just mindful we have already run over our allotted time. So apologies for that, and apologies to those where we haven't got your questions, but we will follow up afterwards to ensure that you get the information you need. So just one last question. I guess a little bit of an outlook piece. You've spoken much about the macro. You've spoken a bit about the markets as well. How are the portfolios positioned, and what environment do you think is in front of it for the portfolios?
Yeah, look, I think, you know, the things that are really stand out at the moment is this ensuing default cycle. I think you really want to be positioned for that, and we've certainly, you know, made every effort to expose ourselves in a positive way to an ensuing default cycle, and that means hedging up in high yield markets. Interest rate volatility is another exceptional area at the moment. As I said, interest rate volatility is basically at all-time highs. You know, going back to September, we had yields of 10 basis points here and volatility of around about 15 basis points. So basically close to a 1-for-1 in terms of sharp. And now what you're actually seeing is rates in the one year part of the curve in Australia up over 3.5%, with volatility now at 140 basis points. So ex-ante risk is really well priced in interest rate markets. You typically wouldn't try to add value through interest rate markets across a corporate cash book. But on an ex-ante basis, you are getting compensated in those markets. And that really goes to this point of when risk starts to reprice in whatever silo it is that you're dealing in. You can use those silos to augment you know, a cash bond portfolio in pretty effective ways. We saw the same in credit. So again, same type of scenario. Volatility had been pretty dormant. We hadn't seen much spread movement over the last 12 to 14 months. You know, these sorts of environments throw up opportunities to add diversified risk into portfolios. We're finding really good opportunities across the default arbitrage space. Again, probabilities of default are moving in very different ways across different parts of the capital structure. That's providing really good opportunities outside of Australia, particularly. And they're probably the core themes. We're playing the inflation game from the inflation proxy side. Again, volatility has started to pop in inflation finally. CPI volatility went, market volatility wasn't moving with it. There's better ways to play volatility than through ZCS at the moment. You can play it through a proxy type of scenario across primarily the US, I'd say, in that market. And they're the core things right at the moment.
Fantastic, Christian. Look, thank you very much for your time and insights today.
Thanks, Javi. Cheers.
And thank you everyone for listening into the Fortlake Fireside Chat. If you've got any further questions, or require any additional information about the Fortlake strategies, please reach out to your Fortlake client service contact or via the inquiries email or phone details which are provided on the website. Once again, we thank you all for your support and joining us on the call here today.